Welcome to PIMCO Pod. This episode examines how the return of elevated bond yields comes at an opportune time to consider shifting out of cash. The Cost of Cash, a $6 trillion question, by Mark P. Seidner and Premal Dawin. In 2023, Bruce Springsteen kicked off a year-long U.S. tour. However, after a concert at the Meadowlands in New Jersey in September, he had to cut the tour short due to a health problem. Not one to let his fans down, he took time to recover and rescheduled the canceled dates for 2024. Now, Bruce is back, thrilling fans who didn't get to see him last year with epic 3-hour sets, including a memorable April performance here in Southern California. There is a parallel today between the boss and the bond market. Like Springsteen's fans who are enjoying a second chance to see him perform, investors who missed out on last year's peak bond yields are now getting another shot as yields reach levels not seen since last fall. The yield on a 2-year Treasury note briefly peaked in October 2023 at around 5.2% before falling by more than a percentage point over the next few months. Thanks to a string of strong economic data, sticky inflation, and a broader theme of American exceptionalism, the 2-year Treasury yield recently rose above 5% again. The best part for investors? This rise comes at an opportune moment to consider moving out of cash and locking in longer-term bond yields. Let's explore why. Sitting on the sidelines. There is currently over $6 trillion of cash parked in money market funds. This is double the average for the past 30 years. The clear benefit of cash is its perceived safety, but the potential drawback is its opportunity cost. With cash out-yielding the bond market, albeit by a meager 20 basis points, some have concluded that cash is king. We disagree. We believe many investors have lagged in their response to a shifting monetary cycle, perhaps scarred by the extreme inflation spike in 2022. Nearly 2 years later, they remain over-allocated to cash and overexposed to high and rising opportunity costs. Historically, cash has almost never outperformed bonds at this stage of the cycle, with policy rates at peak levels and the Federal Reserve poised to cut. Only in 1981 did bond investors have to wait a little more than a year from the initial rate cut to outperform cash. In all other cycles dating back to 1980, it took a year or less for bonds to outperform cash, and not by a little. On average, core plus bond portfolios, or short and intermediate maturities, outperformed cash, as gauged by 3-month T-bills, by about 5 percentage points over the year following the peak in the federal funds rate, and by about 4.5 percentage points annualized over the ensuing 3 years. This makes sense. Mathematically, it doesn't take much for bonds to outperform cash given their higher duration or greater sensitivity to interest rate changes. A yield decline of just about 80 basis points has the potential to generate price appreciation and lead to a portfolio of short and intermediate maturities doubling the return of cash, in line with the historical average. Perhaps the only thing holding investors back from deploying that cash is the possibility that the Fed is forced to reverse course and hike, not cut rates, an understandable concern. In this scenario, likely premised on another inflation spike, the Fed funds rate would not have peaked yet, and the yield curve would continue to invert, potentially giving cash an even greater benefit over bonds. However, we think this is unlikely. Recent data have clearly surprised to the upside on growth and inflation, which might delay pending rate cuts, but we still believe the Fed is keen to start normalizing monetary policy this year. After the Fed's May 1st policy meeting, Chair Jerome Powell emphasized that rates remain restrictive and said another hike was unlikely at this point. In addition, China is overproducing and now exporting deflation to much of the global economy. As we noted in our last PIMCO perspectives, we remain wary of longer-dated Treasury maturities given elevated supply, debt dynamics, and a lack of an appropriate term premium. At the same time, yield curve inversions have not lasted long historically. We can identify 12 distinct inversions going back to the 1970s. On average, these rare episodes lasted about 7 months. The current one has already endured for about 2 years. The longest previously, in 1978 to 1980, lasted 20 months. We are late in the game, indeed. Analog for investors. In 2021, when bond yields first hit rock bottom, we spoke to many savvy chief financial officers who issued debt and termed out their liabilities, locking in historically low borrowing costs by issuing longer-dated debt. There is an analog at this point in the cycle for investors. Consider doing the same with your assets. Consider seeking to lock in higher yields now before the cycle turns once again. Cash rates are only guaranteed overnight and are set to fall when the Fed ultimately starts cutting rates. Terming out and locking in could be a savvy strategy for investors as well. Thank you for listening. That was the cost of cash, a $6 trillion question. For future insights, please follow us on your favorite podcast platform. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.